Do you want to maximize your success with NCUA? Join Mark Treichel as he shares with you the insider's view on passing your exam with flying colors. The With Flying Colors podcast is sponsored by Credit Union Exam Solutions by Mark Treichel. If you would like to work directly with the Credit Union Exam Solutions team and receive support to optimize your results with NCUA so you save time and money, visit us at marktreichel.com to find out more.
Hey everyone, this is Mark Treichel. Thanks for joining me for another episode of With Flying Colors. For this episode, I'm excited. We're going to have a deep dive on the Central Liquidity Facility, also known as the CLF for short. And I have Steve Farrar with me here today, who's going to talk through many of the intricacies of the CLF. Steve, how you doing today?
I'm doing just fine. In the middle of a snowstorm here in Montana.
Snowstorms in Montana, November 7th, and I'm participating from the great state of Virginia, and it's in the 80s. But you're in Montana, so you win.
Yeah.
Very good. All right. So, Steve, if you could give a little bit of a background, your background at NCUA. I know you've been helping me help credit unions over the last 2 years since I've left NCUA. You left a little bit before that, but share with the audience, for those who may not have heard any of the previous podcasts that you've done, a little bit of your background at NCUA.
That's great. I did about 30 years with NCUA, working up through the ranks as an examiner, and then spent a great deal of time as a problem case officer out on the West Coast mainly. Then I went into the central office and served different roles in risk management. And then in my final years at NCUA, I worked heavily on the risk-based capital rule and served as the vice president of the Central Liquidity Facility.
Very good. So you have a very unique view that very few people have ever had, having served as the vice president of the CLF. So you know a lot of the inner workings and understand the regulation and how the Federal Credit Union Act works. And there's been a lot of dialogue in different ways from NCUA recently, and we'll walk through some of that. But in these times that we're in right now, you hear a lot about credit unions having a little bit more concerns about liquidity. The last several years, it was that they had too much liquidity, but liquidity is drying up a little bit, and it has people looking at their options relative to liquidity. And part of that goes to what the purpose of the CLF. So why don't we start there, Steve? Could you walk through the purpose of the Central Liquidity Facility?
In just simplest term, the CLF serves as a federal liquidity backstop to credit unions and the industry. And that's really what it is. It has the ability to borrow from the federal financing bank in the event when liquidity is really tight.
And that actually came in quite handy during the 2008, 2009, the Great Recession, when there were liquidity issues all around the planet. Credit unions didn't escape that challenge because of the challenges of the corporate credit unions. And the CLF was, again, a wonderful tool for credit unions, which partially allowed the NCUA to hold to maturity those bonds and those assets that had been purchased in the corporate credit unions that were virtually worthless or pennies on the dollar until liquidity returds.
Yeah.
Go ahead, Steve.
Let me kind of just go over that, because a lot of people, enough time has passed, they probably don't remember what all the CLF did in that, and all of the things that had to take place for the CLF to be able to do that. They had to have Congress remove an appropriations limit on how much borrowing the CLF could do, because at that time, while the statute allowed them to borrow more money, the appropriations rule allowed them to only have $1.5 billion. So that had to be changed. And then they did all these lending programs to put liquidity into the system. Some people might remember them as the Credit Union System Investment Program, which was a SIP program, and the Credit Union Homeowners Availability Relief Program. And those loans that added liquidity in the system totaled $8.4 billion. Then in March of 2019, when the NCUA board took the steps to stabilize the corporate credit union by placing U.S. Central and West Core into conservatorship, the CLF approved a $10 billion advance to the Share Insurance Fund in order for the NCUSAF to extend liquidity stabilization loans to those institutions. So by the end of the year 2019, the CLF's loans totaled $18.3 billion. The other thing that took place about that time is the NCUA board made a change in the CLF's earnings retention policy, and that they started to retain earnings because even though the CLF's operations are very low risk, they're not zero. So they started retaining some equity instead of returning all of it in terms of dividends on the funds on deposit. So those are all the things that took place then. And kind of to go along that is there's a similar thing taking place because the CARES Act allowed the CLF extended some of their authorities temporarily, and those generally expired December 31st of 2021. The NCUA board wrote a letter to Congress in November of 2021 asking that these enhancements be written into permanent statute so they could keep liquidity in the bad times. And those were increasing the CLF's maximum lending borrowing authority. Statute sets its 12% temporarily, 12% of basically equity. And temporarily that was raised to 16%. We'll go into this a little bit more in detail later. They allowed lending to the corporate credit unions. There was greater flexibility in agent membership, and we'll talk about agent membership later, and provided the board with a little bit of clarity and allowed loans for more of the extension of loans and kind of loosened up when the CLF can grant loans. So they've asked that those things be made permanent. Now that's important because there is no guarantee that in the event of a future crisis that the executive branch and the legislative branch will be accommodating. And that is a little bit of a risk that takes place. It's nice to have all of these backstops well in place and not have to rely on, we sure hope that Congress does this, or we sure hope the Secretary of the Treasurer allows these things. Because we did have, Mark, you remember back then, we were in a lot of offices in the Treasury during that time. So
we
just
were.
a reminder.
No, we were, you and I, you're shaking some cobwebs off some memories, some good, some exciting, some scary back in that crisis. And you and I were involved in many different ways. And, you point out the fact that first, some of the things in the language and the change that NCUA was able to get, even though it was only for a year or two, as tied to the CARES Act, was from lessons learned. As you said, creating a little bit more flexibilities on the loans they could do. And that would have been from lessons learned on how liquidity was utilized in the last crisis and how it might be able to have more clarity around how it could be used moving forward. But if that all evaporates, you can go back to ground zero. And as you said, do it when you have the opportunity potentially to get the votes. Don't let it evaporate or you might not ever get it again. And that's something that NCUA has obviously been very cognizant of. The board's been talking about it. Now, whether or not they'll be able to get the votes to make it permanent or extend it again, your guess is as good as mine, because as they say, that takes an act of Congress. But all great points, Steve. One other thing that popped into my head is that $10 billion in liquidity that you mentioned. At that juncture, the role that I had, I was the regional director in Albany. The corporate credit union program, who was the person in charge of that, was retired. They asked me to serve as the acting director of the corporate credit union program. And I was actually making that request. We put $5 billion into one institution and had the ability to put $5 billion into one in US Central, one in West Corp. And before that, the biggest ask from the CLF was a credit union that I had a few years earlier. So in 1 year's time, I went from having to ask for $300 million in liquidity from the NCUA board and explaining they had not seen it yet that happen either, right? So it was a $300 million ask, and it was a huge ask, and it was not a controversial ask, but a lot of heavy lifting to get that done. And then 15 months later, we were asking for $10 billion. And I just remember pausing when I was doing that, the irony of the difference in all those zeros. But by having all those zeros, you have the ability to help more credit unions, ultimately. That's a good kind of primer to get the conversation going. And so, Steve, over the last year, the NCUA board has done two briefings, two credit unions. The NCUA board meets the third Thursday generally of every month other than August. And so far, they've had two briefings on this topic. Could you walk through if there's anything you'd like to add relative to why they did that or what was discussed at those briefings?
Yeah, it is interesting, a commentary on the importance that they're placing on the CLF at this point in time. The first briefing was in January of 2020, and the one was just recently in October of 2020. And there's the slides that you can look at that were presented to the board at that time, and they would provide a lot of details that I'm just not going to go through because time won't allow it. Some of the finer details about the CLF, and those are a useful source. So keep that in mind as you go forward. The other thing that they have changed and commented on there is they've made the CLF now a permanent office. When I was there, I was the vice president and there was a president, and we did that job and other duties as assigned. And now they've made the full-time position for the CLF president. And I do believe that the vice president will be a full-time position. And the CLF has one other just excellent staff accountant that's just wonderful. So they've changed the emphasis that the staff is now dedicated to the CLF, which has allowed things that I can see already. When I look just at the website, they've improved all of the forms that you would go to for membership and loans and all that, and it made them PDF compliant that you can do the inputs on them, and added a lot to the website that has frequently asked questions that would help you if you're considering the CLF and want more information. The other thing I always tell people that I would look at is the audited financial statements of the Share Insurance Fund, and all those includes a statement from the CLF. And the footnotes really tell a tremendous story and help fill in any questions that you might have. So I really tell people that's very useful and something I reviewed in preparing for this presentation. The other thing I commented on is back in 2009, the CLF started retaining capital for its own losses. And they don't just retain willy-nilly. We do study how much equity the CLF should hold, the same as a credit union does, and looking at our risk probability of default and loss given default analysis was performed. And that's what determines how much retained earnings that the CLF has from the investments and covering operating expenses, and then the rest is paid out in dividends. So that, in a nutshell, is really just the operations of the CLF.
Got it. And you mentioned a lot of documents there. I'll try to remember to put those into the show notes, but you made me smile when you referenced footnotes. You were the guy way back in the beginning of my career at NCUA that turned me on to looking at those footnotes. There's treasure in those footnotes is what I learned from you way back when, Steve. And that always tends to ring true. And as you said, there's things there in the CLF. If you really want to become a student of the CLF, check out those footnotes. So that's great. So we've walked through the briefing. So we've walked through the general operations of the CLF and things that are going on because of what you've seen in those briefings. You mentioned the November 2021 letter to Congress. Is there anything else relative to that letter that you think we should highlight here today?
No, I don't think so. And then that letter is on the website and can be pulled down, but it's a very short letter so that Congress can read it quickly and get the sense of what they want. So CLF borrowing ability. We've talked through the fact that the CLF has the ability to borrow, that we utilize that quite heavily during the last crisis. That led to, when the CARES Act came out, NCUA wisely going to try and get some things put in place so they could have broader authorities on the borrowing authority, and that's about to expire. Anything else you'd like to add relative to that particular topic? Yeah, and there in the comments that the board members made at the October session, you can read those, and it provides a little more on this, but I'll cover a bit of it that really should take care of that. The CLF's borrowing authority is based on the capital stock and its surplus. It's a statutory limit that's 12 times that amount. So temporarily, the CARES Act raised that to 16 times, but that expired on December 31st of 2021. So now you look at what the capital position of the CLF is now, and take that times the 12 times. And so they have the borrowing authority of $29.3 billion. So you kind of look at that and go, wow, during that corporate crisis, it had loans outstanding of 18 billion and inflation and all that. And so that's when it tells you that there's not a lot of margin for error. Now, because of an item that I'll cover in more detail, but I'm going to cover it, how it affects capital now. The corporate credit unions were allowed to do agent memberships, and we'll cover that in detail. But those agent memberships came about because of the CARES Act, and that added about $400 million in on-book capital and a borrowing authority of about $9 million. Or, in other words, has that increased the amount of CLF capital stock, and you take it times the 12 times, that generated an additional $10 billion in borrowing authority. So now when that expires and those funds have to be returned on December 31st, 2022, the CLF's borrowing authority will be reduced to $19.6 billion, which puts it pretty close to where it was in the crisis. The source of funds that the CLF has is from its own funds, and it can borrow from the Federal Financing Bank. We have an agreement with the Federal Financing Bank. It works pretty well. It's renewed every year. But that really is briefly a description of the CLF's borrowing authority.
Got it. And so there's two variables there, right? The CARES Act gave a 33% increase. Instead of a multiplier being 12, it was 16. And it also allowed for lack of a better word, the creation of some capital, which increased the multiplier. So the result is when this expires, $10 billion of borrowing authority available to the credit union system goes away if it's allowed to expire. Got it. So let's go in a little bit more detail to the agent membership concept, what that means, how that works, and any other just general thoughts or comments on that.
Yeah, that's a good one to go into now. As I said, the CARES Act temporarily allowed the corporate credit unions to become what's called an agent member of the CLF to a subset of their members. And that was with the uniqueness of the CARES Act. So what happened in May of 2020, because of this act, all of the corporates joined and purchased capital stock for their members with assets less than $250 million. And so that is what contributed to the increase in the capital stock of the $403 million that's on deposit. And that provided the federal backstop and liquidity for 3,641 is the latest number of the smaller credit unions that now had access to a federal backstop. It's about to end if no changes in the regulation. And as we talked about before, is the reduction of that capital being paid back out, and the reduction it has in terms of how the multiplier is determined in the borrowing authority. That's where the $10 billion reduction in the borrowing authority comes about.
Got it. Go ahead.
Yeah, and when those corporate credit unions funded that amount of capital, and they'll get it back, and then they were paid a dividend on that, and I'll go through that dividend process in a little more detail with natural person credit unions. So this is an important issue for the smaller credit unions in that they've lost that federal backstop.
Got it. No, this is a big loss for the small credit unions if it does evaporate, that's for sure. Yeah, so that's a good segue into the natural person membership. Why don't you kind of walk through, you and I know what natural person credit union means, and if you kind of look at the words, you might be able to figure it out or suss it out, as they say. But in NCUA nomenclature, what's a natural person credit union, and then what's a natural person membership of the CLF?
Right. Yep. So the natural person credit unions are those credit unions serving credit union members versus the corporate credit unions. That is the important difference between an agent member and the natural person one. So what happens now is the credit unions who now lost that backstop, that feel like they need something in terms of liquidity, they all have the ability to become a natural person member. And you become a natural person member by filling out the application that's on the website, which I recently said has been much improved. And then you subscribe to the capital stock of 1% of paid in and unimpaired capital and surplus. Now you have to put on deposit with the CLF 1/2 of that amount, and then the remainder is on call. The amount that you have on deposit is adjusted after the year-end call report is in, and that provides a couple of things. It helps, it maintains the right capital base based on the membership of the CLF, and it makes NCUA go back through working with the wiring instructions that we have, so we keep those more up to date. So that has an extra benefit. So now on that amount that you have on deposit at the CLF, a dividend is paid on that, and it's pretty close to generally almost exactly the same as the Fed pays on excess deposit. For example, in the third quarter of 2022, it was 2.24%. And prior to that, it was less than 1%. So that shows that it does keep pace with the increase in general interest rates. The CLF, the dividend has increased that amount too. But the CLF, of course, invests very short term, number one, because now it's facing the payout of so much of the agent memberships. But generally, it does invest rather short to keep its purpose as being a liquidity source. And the earnings that it has allows it to be able to pay the dividends that are paid out. There are 352 regular members. And there used to be a waiting period for getting a loan on that, and I think that's been waived. But the website does a wonderful job of guiding you through and including all of the calculations that would go into determining how much you'd have to have on deposit. And then the agreements are fairly lengthy, but easy to understand.
Steve, that's about, if I did my rough numbers, that's about 7% of credit unions belong. And probably the bigger ones do it. As you said, the smaller ones are currently covered through this other arrangement, but there's benefits no matter what size you are. You could argue that maybe a smaller credit union, it might make more sense because of some of the advantages that it gives you. And yeah, I know we're going to talk about borrowing from the CLF, but other than for the good of the order and making a deposit that makes a decent return compared to other options, and the fact that you have this deposit and you buy this stock, I guess it's a stock deposit unless I'm mixing up my definitions here, that helps the multiplier. Do I have that right?
Yeah, it does. The more members that the CLF has, the greater its borrowing authority becomes.
Back to that multiplier of 12 or 16, depending on which operating rule you're under. Now, the other thing is let's speak a little bit to the borrowing from the CLF. If a credit union was going to want to work with the CLF, they find themselves in a liquidity crunch. What do you have to say about how that works? And then as a follow-up question to that, or maybe you'll deal with that, are there advantages, and I think there are from having listened to the webinar, are there advantages to being a CLF member before you find out that you need the liquidity as opposed to thinking you might need it later as far as timing and things like that? That was a mouthful. So let's talk about borrowing from the CLF.
Yeah, and in terms of the natural person credit unions, it'd really be looking that for the CLF members, it's real dependent. Some credit unions operate tighter liquidity than others. So certainly, if you're a credit union and you earn tighter liquidity, the federal backstop that you need to comply with the regulation, the CLF is certainly great, serves that purpose. Now, if you're somebody that has a lot of liquidity, don't have a lot of loan demand, you may not have as much need to be on the CLF. Now, what happens is if you have low liquidity, suddenly an event happens and now you're faced with a liquidity problem that can't really be resolved from general market sources, then you have to look to the CLF. The CLF's lending authority is limited limited by the statute. And we're back to that they can't make loans to expand a credit union's loan portfolio. But the CLF can grant short-term adjustments, and those are 90-day ones, and those are generally from credit unions that are affected from a short-term outflow of funds, and these generally occur in terms of like the hurricanes and those types of disasters. And those ones could come into play because when an area is affected by a hurricane, there's an initial flood out of liquidity. as everybody has lots of stuff to buy and stuff. Then as insurance payments come back in, it quickly becomes a great amount that comes back into the institution. And it can be difficult for everybody to start putting those funds to use because there's just limited resources in the area. But that's one potential use of it. There is a seasonal loans that can be done for those institutions, like agriculture ones that have a big outflow of funds at certain times of the year. Those are generally limited to a 270-day maturity. There are protracted credit adjustment, longer term ones that can be done. The important thing to remember is if you're borrowing from the CLF, you have to be creditworthy. So it's not a source of funds for a troubled institution. It will require approval of the supervisory authorities, NCUA, and the state. The rate assigned to those loans is the higher of prime or the federal financing's rate on the advance. And they have to be fully collateralized. And the change has been made. It used to be that we would not lend no more than 90% on even a treasury. And the NCUA board did change that. And that is listed in the CLF collateral margin table. So if you're going to look at borrowing from them, you can pull up the CLF margin table and look at, these are the instruments that we would believe we would have available to post as collateral for that. And you would be able to see how much you would be able to borrow based on that available collateral. And they do require, of course, that first lien interest on that. But yeah, that's really quickly borrowing from the CLF.
That's good information. And if I find myself, so let's say 4 years ago, I was CEO of a credit union. 4 or 5 years ago, I decided I wanted to be a member of the CLF. And I find myself today potentially wanting to borrow short term. Compare and contrast that to someone who today is starting to have that liquidity problem, but they want to sign up. Is there an advantage to having been a member for 4 years and having all the paperwork done, the wiring instructions all done, the approvals? Because if the other thing is, I guess if I'm going through some liquidity challenges and wanting to join, I might not be the only person in line. And that might slow things down at NCUA or my state regulator or not. Compare, contrast those two. Is there an advantage to being a member as far as the speed of getting the...
Just a marginal. Now that the CLF has a full-time staff, I would believe that applications would be able to be processed very quickly. And like we did in 2008 and 2009, we deputized a lot of people to be loan officers for the CLF. That was another one of my duties during the corporate crisis.
I state your name. You are deputized to make loans. Got it. Yeah, I remember that.
Yeah, and so it has the ability to staff up in the event that it's got a bunch of application and whatnot. The other thing that's keep important is if you're doing it now in kind of reaction to a liquidity outflow, it's really hard to look at. I'm going to acquire this liquidity source, but now I got to put this money on deposit with them.
Right.
It kind of seems a little
defeats the purpose, and it might be you're putting more on deposit than the ability to...
On the short term, it looks like it doesn't help your situation if you look at it in a really short run. So those people, of course, that have been members for a while, that money is sunk into the CLF, and they are receiving a reasonable return on that, and they wouldn't have to come up with that at the worst of times.
Got it. This has been very informative. When I think of liquidity, somebody once said liquidity doesn't matter until it matters, and then it's the only thing that matters. You and I have been involved in institutions like the corporates we mentioned, like some other troubled institutions that had long-term assets on one side, and it went from an asset issue to a liquidity issue real quickly. When your liquidity dries up and you have monumental issues there, it can be a challenge. And now that's not exactly what the CLF is for, because it's there for other purposes and not the longer term, et cetera, et cetera. But it is a great tool for credit unions to consider. And there's a lot of good information out there. And before I wrap up this episode, Steve, is there anything else that we should mention to our listeners relative to the CLF today?
I would say if you have any questions at all, I would reach out. The CLF does have a phone number, and I'm sure it has an email address that I believe you would receive a very quick response, and they would be able to answer any detailed questions that you might have. Anthony, who did the presentations, is a very knowledgeable, Anthony Capetta. He's a very smart person, and I got to work with him before I'd left NCUA. So I anticipate that you would be pleased with your interactions with the CLF staff.
Yeah, he's a smart guy. He's the president now. They're looking to fill the vice president. And again, more resources there, more professional website because they've got more resources to donate it to it. Steve, I want to thank you for your time today and sharing the knowledge you have, again, that very few have relative to the CLF.
Thank you.
You bet. And listeners, I want to thank you for joining me for this episode of With Flying Colors. I hope you enjoyed it. And I hope you'll listen again soon. This is Mark Treichel signing off with Flying Colors.
Thank you for joining us on this episode of With Flying Colors. Subscribe on your favorite podcast app to hear future episodes where subject matter experts of all varieties will provide tips on how to achieve success with NCUA. If you would like to learn more about how we assist credit unions, check out our services at marktreichel.com.